Hey guys, Snarf back again. So with the market being as it is lately, it's been looking good. I think it's time for another portfolio update.
The World of Snarf.
So this is going to be a total portfolio update. I'm going to show all three accounts: my Acorns, M1 Finance, and Fidelity Go. So let's go ahead and dig in. I'll try not to keep you guys for too long. All right, so here we are. We're starting off with Acorns. So just at first glance, you can see all-time market gain or loss. We are finally positive. So I started using Acorns again when the market was in sort of a downturn. I was seeing a lot of losses. But now all-time, even with Acorns maintenance fees, I'm at a gain of almost $20. And that's just going to increase from there. So let's just look at today alone. Let this populate. Come on. All right, so there's all time. Here is 1 year. Here's half a year. And then here's where it starts looking a little bit better. Here's the 3-month. You can see that return. The 1 month. And then just today, it'll look a little crazy, but that's what we're looking at. So we're at a value of $1,438.35. So let's just look up quantity. So here's the different shares of these stocks. As you know, these are Vanguard stocks or funds. So they're a little bit more expensive, but you buy them in fractional shares. So that's what we're looking at. You can see how the portfolio is broken down. Those that have the aggressive portfolio on Acorns knows that this is sort of the breakdown. So if we look at that in terms of dollar value, this is just sort of the breakdown of that. Percentage, they do 40% large, 10% emerging, 20 international large company, 20% small, and then about 10% real estate. So yeah, Acorns is performing very well. I'm still using it because I'm looking forward to some of the advantages Acorns can provide me. If their spend card does really well, if I get a bunch more referrals, if there's more cash back opportunities and the found money. So I'm looking forward to that. That's why I kind of keep this account open as opposed to dumping this money into M1 Finance, which has been performing a little bit better. But this happens in the background. Acorns rounds up and has recurring investments, so I keep it going. So found money, we're still at $13.21 invested. Referrals is still $10. Dividends still $10.99 for a total gain of over $20 right now. Potential. Let's see what it thinks I'll have by the time I'm age. I think it's like 65. Okay, by age 64, it thinks I'll have $162,484. And that's with a pretty moderate market. If it's very aggressive, I could have upwards of like $325,000. But I'm not gonna hold my breath for that one. So that's what Acorns is looking like. Let's go on over to M1 Finance, which is where most of my excitement is coming from. All right, so the Dividend Digest portfolio. It has been performing really well. So here's all-time gain, almost $800 on this portfolio. I did start this portfolio. Let's see, when did I start it? Should give a, let's see. So I started back, looks like August 24th, 2018. Oh yeah, it says right there, August 23rd, 2018. And we've already made, yep, $800. So from dividends alone, I've had $84.44. So that's a pretty big chunk of that $800 just in dividends. The rest of it is appreciation on my stocks. So let's go ahead and look. We still have good, the Gladstone. So it's up $223 all time. Capital Southwest, I really like this holding. It's done really well. It's up almost $80. Gain, which is another Gladstone, it's up over $150. Norfolk Southern, so this one kind of surprised me. I took a risk on this one and just invested while the market was down. It's not a real huge dividend player. It does pay dividends, but I just thought it'd be cool to own a railroad company just because that's always interests me as far as logistics go. Let's just click into that. So my average share price on this is about $160, and if we can we dig into this? Right now it's at 183.49. You can see it has less than 2% dividend yield, which, yeah, that's kind of low. But for some reason, this stock just really caught my eye. Let's just look at some of the dividends. So, I mean, they've had good dividend growth over the past 3 years. So from 61 cents to, an 11-cent increase. Here's an 8-cent increase, and that was just last year. Here's a 6-cent increase. So, I mean, they've shown growth, which maybe that's why I went and did that. But yeah, extremely happy with how they've been performing. So, yeah, we'll let that one stay in the portfolio. Let's see, how do I go back to my... Here we go. Coca-Cola right now is the biggest loser in this portfolio. I've been sniping it once it goes under $45. I've been putting my cash into it because right now I'm just holding cash. I feel like a lot of these stocks are overvalued right now, so I'm letting my portfolio sit, and I'm just sniping stocks as I feel they go under the value that I want to buy them. So Coca-Cola, I'm trying to buy it as it goes under $45, just because I want to bring my average share price down. Right now, my average share price on these 22.8 shares of Coca-Cola, it's $47. I think that's a little overvalued for Coca-Cola. So I'm waiting for it to, maybe dip down to $44.90 or something and maybe put some more money into it. So we'll see. I'm just holding cash and waiting on that. Let's see. Procter & Gamble's been performing well. $85 gain. Apple Hospitality REIT, 80 gain. Realty Income Corp, the monthly dividend payer, so to speak, is $73 gain. AT&T, this one's $12. Not huge. Did take a little bit of a hit, but I bought into it more. So it's a good quarterly dividend player. Let's see activity. So I had some dividends fall in the other day. Here we go. So here were some good dividends that fell in. Realty Income, $327. Procter & Gamble, $723. And Apple, $599. So that's awesome. So the dividends are really starting to roll in there. And I'm going to see some good compounding. It took a while for this portfolio to take off and finally start doing that. But now that it's finally there, I'm really excited to see what I can do with this. So even if I hold those dividends as cash, it gives me a lot more buying power to snipe some undervalued stocks once they go on sale, so to speak. So yeah. So it shows a 27.42% return. That's very skewed. Let's just go to total holdings. So if we scroll down here, let me move my big head real quick. All right, so down here you can see, let's see. So my cost basis is $10,662.01. The value is $11,404.20 for a gain of $742.19, which is almost a 7% return. I'm sure there are stocks out there that perform way better than this, but 7%, that's pretty good, especially considering how diversified and how many different holdings I have. So I'm very happy with that. Yeah, so that's M1. This is the portfolio. This is the money maker. This is the most fun to watch. So it's been performing very well, and I can't wait to see where it goes in the next few months once more quarterly dividends start paying in. All right, here's Fidelity Go. So this is Alexis and I's kind of joint investment account through Fidelity. So we are almost to $8,000 worth of value in here. Let's see where we're at. So this graph that they have, if you just select a spot on the timeline and basically hover over it, it'll show you how far you're up from your cost basis. So right here, as of February 20th, we are up $235.73 overall. So I put in $75 into this account every month. I believe it hits on the first of each month, kind of like my mortgage. So that's sometimes kind of hectic. But my mortgage payment and the $75 coming out all at once looks like a big charge on my bank account, but that's okay. So you can see we've had $75 deposited here, and here. Next one will fall in March 1st, if that's on a weekday. So life of the account, so it says it's up 1.44%. So that's good. It's positive. That's not beating maybe some powerful savings accounts, but that's still positive. That's still money gained. Here's a breakdown of the portfolio itself. So domestic stock, it is 36% in domestic stock, 15% in foreign stock. A good conservative 50%, 49% in bonds, and then short term, which is almost like cash, makes up less than 1%. So that's just like safe. That really can't change in value, just really gains interest. But if you want to see what these actual holdings are, so domestic stock, FDFIX, that's the Fidelity Flex 500 index. So these are index funds, which are awesome. They mimic the market index. So a lot better than mutual funds. Usually no expense ratio with these. So almost like an ETF index fund. So Fidelity Flex Small Cap Index Fund, FLXSX. Fidelity Flex Mid Cap Index Fund, FLAPX. And then here's what percent of the portfolio those funds are. So domestic stock altogether is 36%, but then what the three funds in there, how do they weigh in? Foreign stock is just FITFX, which is the Fidelity Flex International Fund. That makes up 15.41%. Here's two bond funds, FUENX and FUEMX. So one's a Flex Municipal Income Fund and one's a Conservative Income Municipal Bond Fund, which again, they make up about close to 50% of this portfolio. And then short term, so cash reserves, like I said, this is cash. Basically, value of the cash in there is going to be the value of the investment. So it makes up, like I said, less than 1%, only 0.43% of the value of this portfolio. So there you have it, guys. An update. The market's been doing really well, knock on wood. So hopefully it continues that way. I'm trying not to buy as much right now with the market going up so much. Just going to kind of wait until some things sink a little lower and try and snipe some good price stocks. A lot of earnings reports are coming out, so I'll be on the lookout for that. And hopefully you guys will be doing the same strategy to sort of get your average share prices down. Other than that, guys, I don't have anything else. Hopefully this update was entertaining to you. You liked seeing how it's progressing, how the portfolios are doing. Hopefully it's interesting. Maybe you get some inspiration. Maybe it motivates you. But until the next one, guys, thanks for watching. Go ahead and comment, like, subscribe. Let me know what you thought, and I will see you later. Thanks.